try that you take about 3 questions.
Max.
Max.
Because I have to really be out by 10:30.
Yeah.
So already 10:08.
Yeah. So we are starting. You speak for a few minutes.
I'll speak for this about
That's wonderful. That's wonderful. That will leave just the right amount of time for questions. Great.
No, that's okay.
There is some summary of the presentations for which I'm not really talking about.
Great, thank you. Good morning, a very warm welcome to you all. We are starting the program a little early because the Chief Economic Advisor, Dr. Anantha Nageswaran, has to leave sooner than we had expected earlier. But he has been really kind and generous to still make the time to be here with us. 10:30 is the hard stop for him. So the change we have brought to the program is that Dr. Nageswaran will speak for a few minutes. About 5 to 8 minutes is what he has told me. But he has agreed to take a few questions from you. I know we have friends from the media, friends from the embassy, and other partner think tanks. So I think we'll have room for about 3 or so questions. Keep them ready. And after Dr. Nageswaran leaves, then Ms. Lena Schipper will continue the program as we had initially planned it to be. So with that, over to you, Anantha.
Thank you, Poonam. Okay. Good morning, everybody. And thank you for accommodating the sudden change in circumstances that necessitates this rearrangement of the program. So we have seen the World Economic Outlook that the fund brought out in April. For the year that just ended in March 24, of course, right now the official MOSPI estimate of growth, which will be updated in May, is 7.6, but the fund itself has projected a number, if I'm not mistaken, 7.8% for FY24. But if you look at the trajectory of growth in the first 3 quarters, obviously the possibility that the growth rate touches 8% is quite high. And as of now, I think the fund has an estimate of close to 6.8%. I'm just quoting from memory for FY25. But the Reserve Bank of India expects a 7% GDP growth for FY25. If that materializes, of course, it will be the 4th consecutive year after COVID, for starting from FY22, that the economy will have grown at 7% or more. If the RBI forecast of 7% for FY25 turns out to be either correct or even an underestimate, then it would be the 4th consecutive year of 7 or higher growth rate. Of course, a lot would depend on how the monsoon shapes up. Right now, the expectations are that we will have an above normal monsoon, but spatial and temporal distribution will matter. The key, there is always a question mark in the minds of the people about the private capital formation. Is it taking off or not? But if you had taken the time to examine the national income accounts data for FY22 and FY23, we could see that, yes, during the year 1920, partly due to the lingering balance sheet issues at that time in the banking and non-banking financial sectors and the corporate sector, there was a decline in the gross fixed capital formation of private non-financial sector. That is what the national income accounts data tells you. It continued in 2021 as well. So there were 2 years in which GFCF, as we put it, in the private sector had declined. However, there has been a very significant pickup in 21-22 and 22-23. Bottom-up corporate data suggests that it has continued in 23-24 as well. So in that sense, I think the story of the private sector coming off its balance sheet issues in the second decade and also having accumulated net saving surpluses in the last few years. If you look at the RBI data on flow of funds, we can see that or the MUSPI data, you can see that private corporate sector has savings minus investment surplus. Usually, it is the case that the household sector saves and other sectors have a savings minus investment negative gap. That's how it is. But the private sector savings minus investment surplus is a slightly positive number over the last 3 years. But the gap is, but the positive surplus is shrinking, which is good, which means they are investing. The household sector's net financial savings flows, I repeat, the net financial savings flows were lower in 22-23 at 5.1%, which was already well flagged, and there were some concerns expressed that this is that households are now saving less. But if you noticed, bulk of the savings was a portfolio shift. It went into real assets. Considering the slump we had in the real estate sector in the second decade, and therefore the prices being on the lower side as the decade wound down, it was a good portfolio shift. But it has, because the households running down the financial savings to accumulate real assets keeps the flow of savings and investments within the economy, it was not leaking towards consumption, and therefore to the external side, our external sector balance remains quite comfortable. As we go into the rest of the decade beyond FY25, the omens are good for us to continue the steady growth rate of between 6.5% and 7%, because the key difference this decade compared to the last is the one of balance sheet strength in the financial sector and the non-financial sector, in the corporate sector as well. And it's important that we maintain this, and therefore the gap between two financial cycles has to be lengthened as far as possible, and that is what will give us the kind of improvement in standards of living and employment generation that we aspire for. If after every 4 or 5 years in the past that we used to run into overheating issues, then that would be a challenge to achieve a material difference to people's lives. But the signs are good because of the investments we have made on the supply side, both physical and digital infrastructure, etc., that the economy is better placed than before to be able to pursue non-inflationary growth. I'll stop my remarks here, given the fact that I told Poonam that I would probably speak for about 7 to 8 minutes max, and I think I probably come to the end of it. So I think it is a good note to end my initial remarks. Thank you very much.
So we'll take a few questions, maybe about 3. Yes, Sapna over there. Yes, so both of you first, Sapna and you, and then we'll take. So that's all about it.
Yeah.
Thank you, ma'am. Hello, sir. Good morning. So you mentioned about the possibility of 8% growth rate being quite high for India. But in the coming years, 6.5 to 7% is, ideally what we should be looking at, or at least aiming at, also to avoid the overeating aspect, etc. So this 8% versus 6.5 to 7%, could you give us another perspective on the numbers?
I'm not quite sure I get the question.
No, I mean, you mentioned that the possibility of India growth touching 8% is quite high.
That is for FY24, the one that finished. Yeah.
But in the current and the coming years, 6.5 to 7%.
No, I said for the FY25, I refer to the RBI forecast of 7%. I also refer to the fact that the fund going forward on a medium-term basis has a 6.5% sort of a steady state forecast. That is what I mentioned.
Thank you.
Yeah.
Sir, Ruchika from Business Standard is that. So can you share? So can you share your thoughts on the recent RBI infra-financing guidelines? They have worried the banks a lot.
Yeah, I have no comments. It's a draft guideline. It's a draft for discussion.
So Anantha, that's not taking any time. We can perhaps fit one or two more questions. Yes, both of you in this order. Can you bring it here?
Dr. Nageswaran, can I take you a little ahead in terms of our agenda of 2047 to become a developed country? What do you think would be the growth rate? One is desired and one B is what is achievable. Thank you.
Look, I mean, obviously desired growth rate is what is the whatever we can sustain maximum possible growth rate, but we also need to be realistic about the geopolitical backdrop and the geo-economic backdrop. And therefore, more important than aspiring for much higher growth rates, it's important to maintain moderate to reasonably high growth, but on a steady basis over a long period. I think it's more important to have longer economic cycles than we have had in the past, rather than looking for higher growth in the current circumstances. So what is that growth rate that we would be happy with? Of course, I mean, in an ideal circumstance, if we could achieve the 9.5–10% growth rate that China did between 1979 and 2008, that would be wonderful. But we know that the context has shifted globally, whether with respect to the increased attention and focus on climate change, energy transition, or the geopolitical backdrop, or the our nation's inclination to pursue globalization and free movement of goods, services, labor, etc. All those things have shifted. So in that sense, we need to therefore recognize the context has shifted and be able to grow on the basis of domestic economy strengths, and whatever impediments that are still there, we should try and convert them into opportunities for growth, because removing those impediments such as deregulating the compliances and the inspections we have at the local and state government level, etc., and continued investment in focus on skilling, as well as the health dimensions of our young demography. All those things will help us grow at a steady rate of even maybe close to 7%. And the more we address some of the legacy issues, it can even rise further based on domestic economy strengths. So that would be the focus, rather than sort of, because at the end of the day, what is in our control is the efforts that we take to facilitate growth, but the outcomes depend on a lot of factors beyond our control.
So you had a question.
So my question, I am Sanjay Rai from Lucknow. My question is the tax GDP ratio. GDI growing.
Sorry?
Tax GDP ratio, GDP.
Tax GDP.
Tax to GDP ratio.
Yeah, GDP tax ratio. So still this is very less, and what is the plan to maintain as per the developed country? This one thing. There are a lot of scope on different sectors like tobacco taxation, like other luxury items.
Sorry?
There is a lot of scope to increase the taxes.
Look, I'm not the revenue person, so you should be asking the question about taxation plans to the revenue secretary. But what I will say is that tax to GDP ratio has been steadily improving, both direct and indirect taxes put together. And I think the kind of tax to GDP ratio we have for an economy of this per capita income is commensurate. Okay, and sometimes if the tax to GDP ratio is rising much faster, then maybe you are probably taxing the economy too much, and it could come in the way of economic activity. So I think we need to appreciate the fact that personal and corporate income taxes and the goods and services tax, all three of them have been registering healthy growth, either in line with or above the nominal GDP growth, and therefore the tax to GDP ratio is steadily increasing. I think we just need to allow the organic evolution of these trends.
Thank you.
Okay, sure.
We'll collect the questions.
Okay.
You and me.
Hello, sir. This is Surbi from Business Today. So you spoke about how the economy is now better placed to look at non-inflationary growth. So just wanted your view on inflation and its trajectory, because food prices continue.
Look, I mean, at the moment it is well within the RBI's reference range, and I think the expectation is that subject to the monsoon, it will continue to head towards the midpoint of the range, and that is what the midpoint of the target range. And that is what both the fund as well as the bank, as a Bank of India, are expecting. So that is our view on inflation. We don't see, we don't see at the moment, we don't see the scope for nasty upside surprises at this point. There can always be scenarios in geopolitics that can cause inflation to be more than what we expect. But at this point, our baseline scenario is that the inflation gradually converges towards the midpoint of the target range in FY25.
So 4%.
Yes, that's the midpoint.
So, question to the lady over there. I have a slight gender bias, as you can see.
Please go ahead with that.
Hi, sir. Good morning. This is Ruchi Bhatia from Bloomberg. I wanted to understand from you, you said for long-term 6.5% to 7% growth, a bunch of reforms will be required. Apart from the ones that you've mentioned, that there is a need for reducing the compliance burden and focus on skilling, what will be some of the other measures that one can look at in terms of boosting the long-term growth potential for India?
No, I think I have mentioned the key ones that are important in my mind, which is what I mentioned. Of course, we can talk about electricity, DISCOM and generation reforms, but more importantly, I think if we have to grow the Mittelstand, the small and medium enterprise sector that was the backbone of industrial development in today's advanced economies, I think that is the segment that we need to grow as well if we are trying to increase the share of manufacturing in GDP, etc. And we have done some of the important requirements, building blocks, such as the supply side infrastructure, physical connectivity, digital connectivity, financial inclusion. All those things are good work in progress. But apart from these, ultimately, the compliance burdens and inspection burdens that businesses on the ground face in the respective locations. And much of those rules and regulations arise at subnational government level. And that is the area where we need to work on to be able to, grow the manufacturing share of GDP.
So yes, sir. This is the very last question.
Thank you so much. So, Dr. Anantha and Manas from IMT Ghaziabad, I have this question. If I understood you correctly, is that there has been some kind of a decline in the financial savings of the household.
No, I was referring to the data that's already out there in FY23.
Okay. So,
it's not a decline in savings, it's a flow. I repeated the word flow. Households are still saving. The flows of net financial savings dropped. So it is like the second derivative.
I understand that. So if there is a decline in the flow, so that means, does that mean that it has been because of a decline in the income? Or,
no, I mentioned that it was a portfolio diversification. I think you didn't hear me fully. I said they did, the real assets investment went up.
Real asset investment.
I did mention that.
And what about the consumption?
Consumption growth, in fact, the consumption share of GDP has been steadily rising, so consumption is holding up.
Okay, thank you.
Perfect. Thank you so much, Anantha.
Thank you.
Thanks for being here. Anantha, a picture maybe.
Sorry, my bag is here.
We're taking a
Oh, take a picture. Okay, great. Yes, yes.
Thank you very much. You can now get elevated to this chair. Okay. So. Over to you.
Okay. Good morning, everybody. I hope you can hear me. I think you can. Welcome to NCAER. My name's Lena Schipper. I'm the South Asia Bureau Chief for The Economist here in Delhi. We cover mostly India, but also the rest of South Asia from here. And we're going to hear today about the state of the world economy and how it affects India. We're also going to hear about some changes in the world economy in terms of spillovers from our guests from the IMF. So I think what I'm going to do is I'm going to invite Dr. Andaloussi and Dr. Fernandez-Arias to give their presentations. And then we'll have a couple of remarks from Dr. Poonam Gupta to my right and Dr. Kouamé from the World Bank to my left, who will give their perspective on how these developments affect India in particular. So over to you.
Yes, please.
Thank you very much for the introduction, and thank you so much for having us today. It's a real privilege to be here presenting the latest World Economic Outlook publication that we put out a couple of weeks ago. I will present chapter 1 that presents our forecasts for the global economy. It's a real collaborative effort as every country teams in the IMF provides forecasts at the country level and at the IMF Research Department, where both Nicolas and I sit. We aggregate inputs and present the global view. So let me start with the key takeaways from this April World Economic Outlook. We've seen headline inflation descending globally from its peak in 2022, and that has happened because central banks have tightened monetary policy in a very synchronous manner across the globe and in a very forceful way. And despite this tightening in monetary policy, we've seen global GDP growth being very resilient. We estimate that in 2023, growth was at 3.2% globally, and this is what you can see here in the middle graph. And our forecast for 2024 and 2025 is also at 3.2% for both years. Growth has been resilient because of demand factors. We've seen consumption being very resilient in many countries amid tight labor markets. We've seen public spending also being higher than what we had anticipated. Growth has also been supported by supply factors, with most of the supply constraints from the pandemic easing, with energy prices coming down faster than what we had anticipated, and with a labor force growing fast in many economies. Risks to this outlook are broadly balanced, and we'll get into them in the next few slides. But let me first start with what underpins our forecasts. What are the recent developments in particular that shape up the outlook? First of all, resilience is really the word of this April WEO. We see steady growth globally, steady but slow. 3.2% is our global number, but you see some divergence across countries. On the left-hand side, we're plotting the cumulative surprise in GDP growth in each key areas and for the globe since 2022. Since 2022 forecast that we forecasted in the WEO of October 2022. Since then, global GDP growth has grown by 6.7% cumulatively over 2022 and 2023. And for the world, it's about 0.8% higher than what we had forecasted. In some countries, it's even higher, for example, in the US. One important point to note is that in low-income countries, this growth outturn is actually lower than what we had anticipated. And that's in particular because low-income countries have been hit more forcefully by food and energy price spikes. And this is also what you can see when you're looking at our inflation forecast compared to the outturn, while inflation was higher in low-income countries than what we had anticipated. Where in most countries, our inflation forecast was quite in line with what materialized. One of the reasons why growth has been diverging across countries has to be seen on the demand side. We've seen more resilient private and public consumption in many economies, but in low-income countries where private consumption in particular was lower than what we had anticipated. So we forecast soft landing for most of the world economies, while low-income countries are facing a stagflationary environment. And so one of the factors that really supports growth and has supported growth in 2023 is the drawdown of the excess savings that households had accumulated during the pandemic, and that's been happening really across economies. With the US, that's the blue line here, really leading the way in drawing down these accumulated savings that has supported private consumption. Monetary policy has tightened globally, but most advanced economies' central bank started tightening nominal policy rates after expectation of inflation spiked. That led real rates to be actually lower than zero for most of 2022 and starting to be more on the tightening area in 2023. So that also has supported demand. In emerging markets that have tightened much faster than advanced economies, real rates became positive earlier. On the supply side, we've seen also favorable developments. One important development has been the growth in the labor force in many economies. And we've analyzed this growth and found that in many advanced economies in particular, this was driven by a surge in immigration. Immigrants came and filled new jobs and really helped boost the labor force participation in advanced economies. And that's what you can see here for the US, Canada, the UK, and the Euro area in the two left graphs. On the global side, supply chain pressures and shipping costs really eased also. We had seen constraints during the pandemic, but that has really helped boost supply developments globally. Another key development has been on the front of energy prices. Those have come down faster than what we had anticipated before, and that's particularly true and also true for oil and for gas, where supply has surprised on the upside. A lot of supply coming out of the US really helped ease energy prices globally, despite the fact that OPEC had cut some of its production. We've also seen energy flows coming out of Russia, also helping with world oil supply. Now, turning to inflation. As mentioned before, core inflation has descended and is now closer to target in many economies, but not yet there for many economies. That has been a result of the concerted effort of central banks globally. And one key channel where we can see the effect of central bank tightening on inflation is through the expectation channel, where near-term inflation expectations have really descended in the past year after surging during the early 2022 and early days of 2023. Now, lastly, on the fiscal side, what we've seen is an increase of debt to GDP ratios globally during the pandemic, and a continuing increase in many economies following the pandemic. A key line that I want to focus on here is the yellow line in the middle graph. The middle graph shows general government interest payments as a share of revenues, and we've seen the cost of servicing debt increase globally, in particular in low-income countries where it's reaching about 14%, about double the size it was about 15 years ago. Now, turning to the outlook. Key assumptions that underpin our forecasts are monetary policy assumptions and fiscal policy assumptions. On the monetary policy side, we expect major central banks to start easing monetary policy as inflation continues to descend to target later this year in 2024. On the fiscal side, we expect major economies to tighten fiscal policy in 2024 and for fiscal policy to be near neutral in major emerging markets. With these assumptions, our global forecast is one of 3.2% growth in 2024 and 2025, with inflation coming down, continuing to descend globally. We expect inflation to come down faster to pre-pandemic levels in advanced economies, while emerging markets will see inflation levels similar to the ones pre-pandemic towards 2025. The right-hand side graph shows that most economies targeting inflation will see inflation back to target in the end of 2024 and 2025. Now, turning to our country-specific forecast, I'll just mention a couple. 3.2%. So we're comparing here our forecast, today's forecast, so that's the shaded areas, to our previous forecast that we published in January 2024. One notable change is that we upgraded our forecast for the US in 2024, and that is supporting the global growth forecast of 3.2%. Turning to emerging markets, India remains the largest growth number for 2023, and for our forecast, it's the fastest growing major economy globally, and that is supporting also growth in emerging markets that we anticipate will be higher than global growth at 4.2% in 2024 and 2025. So the short-term forecast is one of steady but slow growth, but we also do medium-term forecasts. Each of our World Economic Outlook forecasts growth up to 5 years ahead of time, and this is what we're plotting here on the left-hand side graph. So in 2000, for example, we were anticipating that growth in 2025, in 2005, so 5 years ahead of time, 2000, was going to be around 4.2%. Today, this number is the lowest forecast that we've had in decades. So our medium-term forecast is one that is particularly low at less than 3.8%. It's actually at 3.2%. And 3.8 is the global GDP growth that we've seen on average for the 2 decades preceding the pandemic. So a low medium-term growth forecast. And when you look at the per capita growth forecast, it's also at its lowest pace for the medium term. And in particular in emerging markets, which suggests that convergence may be slower in the current environment than what we had in past years. Briefly, risks are balanced, so I presented the baseline scenario, and we see risks being broadly balanced. On the downside, new commodity price spikes amid geopolitical tensions could lead inflation to go up, once again with implications for more tightening for monetary policy that could weigh on growth. On the upside as well, we see some factors that could boost growth higher than in our baseline scenario. Particularly in the short term, we could see surprises in fiscal support in the economy in the context of this election year globally. And we could also see productivity improvements in many economies if AI turns out to be adopted fast and lead to spurs in productivity. Let me close with the policy recommendations that we also put out with the World Economic Outlook. In the short term, the key priority globally is to continue to ensure that inflation comes down smoothly to target, neither by easing policies prematurely or by delaying it too long. So central banks need to really achieve a smooth landing through a delicate balancing act. On the fiscal side, we advocate for a rebuilding of fiscal space that is calibrated through consolidation to avoid large corrections later that could have a detrimental effect on growth. For the medium term, policies that can boost productivity would be welcome to boost medium-term growth prospects that are quite low in our medium-term forecasts. With this, I'll stop and give the floor to my colleague Nicolas.
Thank you.
Okay, thank you everyone for coming and for your attention. So I'll be presenting Chapter 4 of this year's World Economic Outlook, which looks at spillovers. Every year, Chapter 4 in April looks at spillovers, and this year we're looking at real spillovers from G20 emerging markets, and this is a joint effort with a large team of colleagues listed on this slide. So the motivation for the subject of this chapter is quite simple, and I'm guessing familiar to everyone in this room, which is that the emerging markets in the group of 20 have, over the last several decades, grown much faster than advanced economies and now make up a significant share of the global economy, and at the same time have become much more integrated with the global economy, both through trade and global value chains, as well as financial linkages. And so on this slide, we have just a couple of ways of seeing some of these points I just made. So on the left, we have these 5-year growth projections for the global economy that come from World Economic Outlook forecasts that Mehdi was just talking about, but now breaking out the contributions from different country groups. You see advanced economies in blue slowing down significantly since projections made in 1990, but also a very important role growing towards the 2010s and then declining a little bit from China and from other G20 emerging markets. So this kind of shows the contribution to global growth forecast in the medium term, as well as the fact that global growth in the medium term is expected to slow relative to what it's been in the last several decades. And on the right, we look at the correlation of growth surprises in G20 emerging markets and G20 advanced economies, and the point of this chart is simply that these growth surprises, so growth outturns relative to what we expected in the World Economic Outlook the year before, have become more correlated. So the red dots are more tightly linked than the blue dots. So this is evidence of kind of increasing integration, and we can kind of break apart this integration into a few different components. On the one hand, trade integration can be easily measured by looking at the export share and import share of G20 emerging markets, both of which have either nearly doubled or doubled since 2000, shown on the left-hand side of this plot, as a share of total global exports and imports. And similarly, looking at global value chains, which is the process by which goods move across borders as they're produced, both for input linkages and output linkages, the median economy has become more dependent on G20 emerging markets, again, by a factor of 2 or more since 2000. It's also the case that G20 emerging markets have become quite important in terms of production of commodities. On the left-hand side, we see the three sort of main categories of commodities: agricultural, minerals, and energy. And in all three, G20 emerging markets constitute close to or more than 50% of global production. With all of them represented, China playing an important role in all three, India and Brazil, very noticeable in agricultural production, and Russia and Saudi Arabia, of course, important in production of energy commodities. But it's not just kind of these broad categories where G20 emerging markets are important. When we specifically look at commodities that are important in the green transition, for demand for which is expected to increase in the coming years, G20 emerging markets also play a very important role. For example, Argentina in the production of lithium and Indonesia in the production of nickel. Moving beyond trade and commodities production, we can look at financial linkages, and we go a little bit more into depth on this in the chapter. But here we just show cross-border bank lending from G20 emerging markets, which is a picture that really conveys the point that G20 emerging markets have become more important as a source of bank lending for emerging markets and developing economies, not in the G20. So smaller emerging markets and developing economies are seeing about a doubling in their dependence in terms of considering the share of bank lending from G20 emerging markets since 2015, so only in the past 10 years. Now, those financial linkages, and we document more in the chapter, are important, but tend to be at a smaller scale than the trade and global value chain linkages that we see growing with G20 emerging markets. And so in the chapter, we focus on real spillovers through trade and global value chains to sort of focus attention on what appears to be the most important and highest sort of scale linkage that's been growing. And so to do that in the chapter, we take essentially 4 different approaches to try to quantify historically what these spillovers have been and what they might be in the future. So the first 2 approaches listed here are empirical in nature and look at historical data, mostly based on the last 2 decades, to try to ascertain, using a variety of empirical approaches, what the impact of fluctuations in growth, either because of aggregate demand or aggregate supply, sectoral productivity fluctuations, what impact those have on other economies globally, regionally, or specifically looking at trading partners and so on, and using a variety of data sources. And then the last 2 try to quantify what spillovers might be in the future using model simulations of a few different types. So I'm going to give a kind of quick overview of all of these, and they're described in much more detail in the chapter. So starting with these aggregate impacts and empirical analysis based on historical aggregate data. On the left, we show essentially, based on a vector autoregression analysis of the propagation of shocks from G20 emerging markets, we can try to quantify the extent to which, when we compare the first 10 years of the millennium to the second 10 years of the millennium, do we see evidence of growing spillovers? And our conclusion, based on the chart on the left, is that indeed we do see more evidence of spillovers in the sense of G20 emerging markets, even excluding China, explaining a larger share than G20 advanced economies of output fluctuations in other G20 economies in the second decade of the millennium compared to the first decade of the millennium. And that's evidenced by the solid dots having a slightly more bias towards being below the 45-degree line on that left-hand side chart. And then we can also quantify kind of what is the magnitude of these spillovers, so like a 1 percentage point sort of growth shock, let's say, in a G20 emerging market. What impact does that have on different regions, depending on where the origin of the shock occurs? That's what we do on the right here. And really 2 kind of messages come out of this. One, that China has sort of impact on all the regions that we consider and is quite significant. Whereas other G20 emerging markets tend to have more regional implications, to their trading partners in their regions. So, for example, we see Brazil and Mexico being quite important for Western Hemisphere economies, and Russia and Turkey being particularly important for Europe and Middle East and Central Asia. And this is a theme that kind of pervades the results that we find, is this kind of global impact of shocks that originate in China, and regional impact of shocks that originate in other G20 emerging markets. The next sort of empirical assessment that we do looks at firm-level data, and essentially is meant to kind of, instead of looking at different regions, we're looking now at firms in different sectors, depending on the sector's exposure to G20 emerging markets, whether it depends on them for demand or for supply. And on the left-hand side chart, we see kind of the results of this analysis when we aggregate all of the data. And what it conveys is that firms that depend on demand from G20 emerging markets tend to see a boost to their revenue growth when growth is higher than expected in G20 emerging markets. And it can be quite significant. So this is, essentially a 1 percentage point growth surprise in a G20 emerging market leads to 0.5 percentage point faster revenue growth in the data for these export-dependent firms. Meanwhile, import-dependent firms see a more complex relationship, and in fact, when we look at the sort of aggregate results, it ends up not being significant, and this reflects the fact that there's kind of multiple sort of ways in which an import-dependent firm can be affected by let's say, a productivity shock in a G20 emerging market. Higher productivity, cheaper inputs increases market share and therefore revenue, but at the same time could also constitute increased competition, as has been discussed in the international trade literature. And indeed, we see that this really depends on the source of the shock. So different emerging markets on the right have different sort of degrees of whether one of these channels is dominant versus the other. So turning to the first sort of simulation-based analysis that we conduct, we use a kind of general equilibrium, like global trade model that sort of takes into account the entire input-output structure of the global economy and can ask the question, what happens if productivity at the sectoral level changes in G20 emerging markets? And in particular, what does that imply for output in other economies, in other regions, and in other sectors of the global economy? And so on the left, we show the results of the kind of what we call the baseline scenario, which is essentially a productivity shock in G20 emerging markets that reduces output in them by 10%. And we interpret the results as kind of sort of steady state comparison. So this is sort of an alternative growth path and is meant to illustrate kind of the importance of these economies in terms of producing inputs for the rest of the global economy and demand for the rest of the economy's outputs. And so what we show here is, when we run this experiment in 2000 versus in 2018, we see a tripling, essentially, of the impact, with large increases, particularly from China and India, we see there. And also, to sort of kind of get a sense of the scale of this impact that we see now when we do the exercise in 2018, we can run the same experiment, shocking, sectors, the same scenario on just the United States, and we find that the impact is quite a bit smaller than the impact of the scenario involving all G20 emerging markets, but even smaller than the impact of the scenario just involving China. So this kind of speaks to this sort of how to quantify the size of these results. And one of the things that this model allows us to do is to really pry open the sectoral implications of this scenario. And in fact, we look at a slightly different scenario where we specifically sort of ask what happens if productivity declines in highly global value chain integrated sectors. So think manufacturing or certain commodity types like mining and specifically energy commodities and others. And we see kind of this heterogeneous impact at the sectoral level in the global economy. So this is showing how value-added responds in the global economy in a specific sectoral disaggregation of the global economy. We see that, for example, certain manufacturing sectors tend to sort of expand. This is, remember, a negative shock in G20 emerging markets. Textiles tend to expand with large contributions from developing economies. Meanwhile, most other types of sectors, like services, trade and transportation, commodities production, tend to contract. So this reflects sort of the specialization of G20 emerging markets and of course, as we can see on the left, the sort of important role of China in generating these results, where lower productivity in G20 emerging markets tends to raise prices in manufacturing sectors, inducing a reallocation in other economies towards production in those sectors, and specifically a few key ones like textiles. And the other one that is important is, of course, this kind of group of sectors: metals, electronics, computers, and electrical equipment. We can look at specifically kind of in this scenario the impact of the shocks that we impose on G20 emerging markets other than India, on India. And here I've expanded it into all 45 sectors that we have in the model. And overall, you can see in the chapter itself, what this looks like for the global economy. The pattern is similar. There's just a few differences, sort of a slightly higher increase in mining, energy, and non-energy commodities, smaller relative increase in textiles, larger in electrical equipment and computers, electronics, and optical equipment, and a slightly different pattern of which services experience the largest declines in value added in response. But overall, the impact on India in this scenario from the shocks to other G20 emerging markets is overall similar to this pattern of certain key manufacturing sectors increasing in response, whereas most other sectors decline. Finally, we have this last scenario where we look at sort of to the extent to which higher than expected, so higher than what we see, for example, in the World Economic Outlook forecast for India, 6.5%. Would higher growth in India, how would that impact the rest of the global economy? So here we're looking not just at India, but all the G20 emerging markets other than China, and to what extent can a plausible growth acceleration, and we define plausible in terms of their historical growth patterns, so what we think growth could be higher than our baseline over the next 5 years, and what impact would that have on the global economy? What we find is that global growth would increase by about 0.5 percentage points over the next 5 years, with about 15% of that increase reflecting spillovers from trade and global value chain linkages from these G20 emerging markets that are growing faster in the scenario, and about 85% just the direct impact from the high scale of these economies in the overall economy. And in this scenario, India plays an important role in terms of creating positive spillovers for other emerging market and developing economies. So let me close by just kind of summarizing our main takeaways, which is that first, growth spillovers from domestic shocks in G20 emerging markets have increased in importance and are in many cases comparable to those from advanced economies. But these spillovers generate winners and losers at the sectoral level, and an important reallocation of economic activity between sectors. And that a plausible acceleration in growth in G20 emerging markets other than China can support global growth in a significant way, both directly and through spillovers. We have a few policy implications that we go through at the end of the chapter, where we emphasize the importance of structural reforms, especially in labor markets and business regulation, to ensure that sectors that would like to expand in response to, for example, what we saw with the price signal in the trade model simulations, are able to do so. But of course, there's distributional implications of this type of reallocation of activity and jobs between sectors, and it's important to then have targeted fiscal support to assist in that process of reallocation of labor, for example, through offering training to people to change their sort of specialization. And finally, because these spillovers are becoming larger and larger, and there's this potential for sort of unproductive policies that aim to mitigate spillovers in an inefficient way, it's important to have multilateral cooperation and international policy coordination to ensure that spillovers can be managed in a productive way and minimize the risks of worsening fragmentation. So I'll stop there, and thank you for your attention.
Perfect. A very warm welcome again to you all. So why are we doing this event really on the global outlook and the Indian outlook? One of the other reasons is that there are very few think tanks or academics in Delhi who do core macro monitoring, projections, making a sense of how the data is coming out. And NCER is one of those few institutions. As a result of which we get a lot of requests throughout the year to talk to people, right? People who are coming from outside, whether they're working for the private sector, whether they are potential investors, whether they are from different embassies. And we generally do not have a whole lot of time to entertain each and every such request. So we thought that we'll start doing a quarterly event at NCER, in which we will, along with our distinguished guests and panelists, we can also give out our views on how we think the economy is evolving. So it's in that direction that we are doing this event today. And just as an advance notice, we'll also, as has been the practice in the past, we'll also be doing an event on the budget, the union budget, when it's presented in around mid-June. A week after that, we'll do a 5 think tank budget seminar. And after that, we have a calendar which we will follow. So if it's of interest, do stay tuned and do attend our events. So World Economic Outlook, what are the implications for India? As we all know, and I'm sure you keep reading about it or keep hearing about it, that the Indian economy has exhibited a lot of strengths in the past couple of years. Growth has accelerated. It's very high. It's very high compared to the recent past. It's very high compared to the global numbers or country-specific numbers. Indian economy has also been quite resilient in the sense that there have been small little shocks here and there, but economic growth has remained high. Alongside, an equally credible phenomenon is that this growth has been achieved along with resilience with macroeconomic stability. The IMF colleagues will recognize that, as would Auguste. He's a trained macroeconomist. When we talk about macroeconomic stability, we talk about a few numbers. We talk about fiscal deficit and public debt, level of inflation, monetary policy, balance of payments, exchange rate, level of forex reserves, and the health of the financial sector. If you look at each of these variables, the Indian economy seems to be doing quite well. So Indian economy has attained growth with resilience along with macroeconomic stability. Now, what implication does the IMF's outlook, which was just presented to us, and I'm interpreting it as a benign global outlook. So what implication does it have for India would be the subject matter of my presentation. So let me just put a little bit of numbers to a short synopsis that I just gave. GDP growth in India has accelerated over the past several decades. If you think of 3 COVID years as an aberration, then Indian economy has been registering a good average annual growth rate in each of these decades, and an annual average growth rate that has accelerated over time. So when you're too close to the scene of the crime, you lose out the bigger picture. And you think, if you're following data on a weekly basis or a monthly basis, there's some positive news, there's some not so good news. We forget about the fact that Indian growth over a long period of time has done well and has accelerated over time, and only 1%. Which means that GDP growth acceleration that we are talking about is translating into even a faster acceleration in per capita incomes. And I think that's a very important thing to remember, that besides the GDP growth numbers, per capita growth numbers, growth of per capita income is equally important, and that has improved much more than the underlying GDP growth numbers. When it comes to India's increased resilience to different kind of shocks, the analysis that we have done at NCER, which I'll try to present in about 5 minutes, shows that typical shocks that used to impact India's GDP growth in the past now matter less. And we have here listed out a few different shocks that have impacted the Indian economy in the past. Political or policy uncertainty. I will not dwell too much on it, but the fact that now elections, both at the union level, central level, and in the states have been decisive. There have been very few changes, midterm changes in the government, and there is more or less a certainty on the policy direction, means that political or policy risks have become much less than in the past. A sharp increase in the price of oil does not impact the Indian economy as much as it used to. This is besides the fact that oil prices are showing moderation, as colleagues from the IMF mentioned, and I'll come to that in a minute. India's agriculture has become a little bit more decoupled than in the past from the quantity or quality of the rainfall. global risk aversion resulting in abrupt outflows of capital from emerging markets also matters less for India for two reasons. First, India now holds a very large level of reserves. Second, it exhibits a certain kind of maturity to be able to respond to such shocks, which come either, as I said, because of global risk aversion towards emerging markets or due to shocks such as a tightening of monetary policy by the US. Financial sector is quite stable. There are very low non-performing loans. The sector has been cleaned up. That includes both the banking and non-banking sector, and it's showing very fast growth of credit along with good asset quality. So let's just look at some of the data and evidence around a bunch of these shocks. So oil prices, as we know, have been in the past a show spoiler of sorts. But oil deficit as a percentage of nominal GDP has declined over time. Oil intensity of GDP has declined over time. So for every unit of GDP that we produce, we need less oil. And there are reasons for that. One reason is that the economy is shifting towards services, which is less oil intensive. The energy efficiency overall of the economy has improved, and there is a shift towards renewables. So which means that oil prices do not impact the Indian economy in the same way as they used to. What we have done here is that we have plotted oil prices along with the current account deficit on account of oil as a percentage of GDP. And one can see a little bit of a disconnect or decoupling in these two variables. And the fact that we expect oil prices to remain low, despite there being geopolitical tensions of significant proportions, means that these shocks themselves will be less severe, and then Indian economy has bought insulation against those shocks. Both of these factors mean that Indian economy will remain resilient. Deficient or erratic rainfall. And here what we are showing are two things. One, we are showing a co-movement of agricultural growth rate with the rainfall, percentage change in rainfall. And here again, you can see that in the last few years, there is a bit of independence in these two variables. In the table, we are showing decadal average, annual average growth rate in agriculture, as well as its volatility, captured through standard deviation of the annual growth rates, coefficient of variation, or just range, minimum and maximum. Again, we can see that the agricultural sector has become more stable. Yes, growth rates are only 4%, about half that of the national average, which means agriculture grows at a pace much slower than manufacturing or services. But the story here is that of less volatility and more resilience. So macroeconomic instability coming from the financial sector, again, is something I've ruled out. India has handled and successfully cleaned up its financial sector after the decade-long crisis of asset quality, and it's unlikely to be a shock to India's GDP growth. As far as macroeconomic stability is concerned, I'm starting from the second bullet point because fiscal deficit and public debt requires a discussion of its own. Current account deficit has been low and is projected to remain low. It's projected to remain low both in the RBI's projections as well as the IMF's projections, and those projections are very close to each other. Inflation has been range-bound. Yes, it exceeds 4%, but it has become less erratic over the past 7-8 years, ever since the inflation targeting framework was adopted. And it accelerated by much less than an average economy globally after COVID. Financial sector I've already mentioned. Balance of payments actually has also shown a great deal of resilience. And it's partly because foreign reserves, the way they have been not just accumulated, but the maturity with which they are used to handle volatility coming from the external accounts and especially on the capital account side. So now from here, let me segue into what the IMF is projecting and what it means for India. So IMF is projecting faster global growth rate than was anticipated earlier of about 3.2%. It's projecting, just as the WTO has, that trade growth would be faster this year than was last year. So last year's the volume of trade grew only by 0.3% as per the IMF, and it had a negative growth rate as far as WTO is concerned, and is projected to grow at 3% this year and about the same next year. Oil price outlook from the Indian perspective is very, very benign. Indian economy, as I said, can withstand the oil price rises better than in the past, and any level of oil prices less than 100 is eminently manageable for the Indian economies, and the IMF is predicting only an oil price level of $84 a barrel this year and $79 a barrel next year. Inflation outlook again, the IMF is projecting that next year, advanced economies will reach their inflation targeting levels of 2%. It's a slow decline, has been a slow decline, but directionally it's in the right direction. And emerging markets, inflation rate remains high, and it's inching down rather slowly. So when you combine all of this, how the Indian economy has done over the long run, how Indian economy has done post-COVID, how Indian economy has become more resilient and its macroeconomic stability, and you combine it with VO's projections on global growth, trade data, oil prices, inflation, one would think that these projections for the economy for the current year, where growth is projected to be 6.6% to 7%, are not just very reasonable, but there is every possibility that the year will turn out to be better than this. The CA was a little bit more cautious on that, but looking at the numbers, just as the last year was a positive surprise, close to 8% growth is what we are talking about, this year as well, one does not see any reasons to be more guarded than this. So 7 plus seems like a good baseline. As I said, IMF and the RBI have all projected that current account deficit will remain low. 1 to 1.5% of GDP of current account deficit is a very reasonable number, a very safe number. Inflation in India has been declining, has not come down to 4%, but that's perfectly fine under the circumstances. RBI has projected inflation only for this year, and they projected it to be 4.5%. IMF has projected it for next year as well, and they expect it to come down to 4.2%, very close to the central parity. Fiscal deficit and public debt is something that requires a discussion of its own, and I'll take about 2-ish minutes, if that's okay, on that. Now, not in just the publication that was presented here, World Economic Outlook, IMF also has another publication called the Fiscal Monitor, in which they give more detailed assumptions and projections on public debt and deficit. So I've drawn a little bit from that, as well as from VO, to understand what it means for India. So IMF has projected that after all that benign outlook, debt to GDP ratio for most countries, except for low developing economies, is going to increase. So for advanced economies, average is going to be 150% from current 112%. And similar is the case for emerging market and developing economies. Fiscal deficit will likely not decline, or if they decline, they'll decline very slowly, and they'll remain higher than the levels during pre-COVID years. So there is stickiness in debt and deficit, and that can be an issue. India's public debt and deficits are considered high from global standards. You know, after all that positive story, we know that debt and deficits in India have been high. General government deficit over a 40-year period only shows one direction. There are ups and downs around the trend line, but trend line has been a positive slope one. Any decline in debt has been temporary. Debt to GDP ratio increased to 90% during COVID, and since then there has been a very slow decline. And the IMF's projections are that in 28-29, in 5 years from now, it will be 77%, still higher than the pre-COVID level, right? So there is some stickiness in how it's going to stay with us. But what are the assumptions that the IMF has on India's public debt? So they are assuming that India's primary deficit minus interest payments, will decline by about 0.4 percentage point over the next few years. But more interesting is the reason why it will decline. So they are assuming that India's public expenditure to GDP ratio will decline by about 1 percentage point, and its revenue will increase by a small amount. And it's very interesting to look at these projections. So is India's public debt and deficit of any concern? I would say yes. The reason is that at this level of debt, the Indian government spends nearly a quarter of all of its revenues on servicing its debt. Fiscal deficit has remained high, no matter what, at about 7% of GDP. Tax revenue to GDP has seen only a modest increase over the past years. Non-tax revenue to GDP has remained stagnant at a very low level. Total expenditure, on the other hand, has some very interesting interpretations. First, India's public expenditure to GDP ratio is not high at all from a global perspective. Other countries at comparable levels of income or even at non-comparable levels of income have a public expenditure to GDP ratio which is much higher than that. But what is significant is that there has been a shift in the quality of public expenditure. There is a lot more capital expenditure than revenue expenditure, and efficiency of expenditure overall has improved. So it's a mixed story. Yes, very high, but there are some signs that expenditure is being deployed better than in the past. Some early indicators that tax revenue to GDP ratio is increasing and will continue to increase. But even so, the way India's public debt is financed, it has not posed and is unlikely to pose any stability risk at this point in time or going forward. It's basically because most of this debt is held domestically, it's all long-term, it's on fixed rates, its average duration is increasing, it's on local currency, and so on and so forth. So just to sum up, yes, Indian economy has become more resilient to the usual shocks, and IMF's outlook means that Indian economic outlook will perhaps turn out to be better than what we are projecting as of now when the year has just started. Macroeconomic stability has been hard won, and it ought to be and will likely be maintained. And that's the kind of commitment one's seeing on the part of the policymakers. As far as public debt and deficit is concerned, consolidation would be welcome, but consolidation would likely come from three factors: faster nominal GDP growth rates, revenue buoyancy of taxes and non-taxes, both at the center and the states, and the quality of expenditure, not necessarily lowering the level of expenditure that the IMF has projected. So I'll stop here. Thank you.
Good morning. I don't have a presentation, and I'll try and be brief. I will, well, first of all, thanks to IMF colleagues, Mehdi and Nicolas for your presentations. It's very interesting, and thanks, Poonam, also for your presentation. Learned quite a bit on your thinking about the Indian economy. I also appreciated Anand's presentation before he left. I'll make my comment in two parts. First, on Mehdi's presentation. And because Poonam has talked a lot about the Indian economy, I'll skip that part. You have the numbers. The only thing I will say on from the World Bank point of view is that our forecast will be updated pretty soon for FY24, FY25. And as Poonam said, it's likely to be upgraded because the signs are quite good about future growth for India. This said, we have, as you heard earlier, there are uncertainties about the future, and the uncertainties are not due to the Indian economy, they're due to the global economy. So by first reaction and perhaps a question about Mehdi's presentation is, in this very challenging global environment, if India can grow at 6.5 to 7%, what will India's growth be when the world economy is more benign and the global environment is more conducive? Can India reach 8%? My hypothesis is yes. In fact, if the world economy were to pick up significantly, I think it will add to India's growth. We saw the correlations in both presentations. So we are in a good place, I will think, in India. If policies, as the chief economist mentioned, can be put in place, I think growth will pick up easily to reach probably 8% when the world economy picks up speed. My second comment is not about India, it's about the least developed countries. It's really worrying, the numbers we saw earlier, that the least developed countries that need development perhaps the most are seeing the biggest downgrade in the forecast from the IMF. And also, whilst they're not highly indebted, they have huge debt service, up to 12% in some cases. So this is worrying because this can represent not only sources of social instability and geopolitical tensions, but it can also obstruct to growth for some countries. And here is the link to India. India is now globalizing. India is connecting to the world, and I'll talk a bit about that on the second paper. But my belief is that the least developed countries represent a potential market for India going forward. So if those markets are dynamic, it would be good for future growth for India. And therefore, as a global community, what can we do to support growth in least developed countries is a question I would like to leave to all of us, both focusing on India as well as focusing on the global economy. My third comment and point on the first presentation is coming back to India. Whilst I said earlier India could easily grow at 8% if the world economy and the global environment were to become more conducive, it would be interesting to know what is India's real potential growth. At the moment, I don't think we have agreement on India's potential growth. I think each of us has data that we walk around with. Mine is around, or ours at the World Bank is around 6.5%. But if that's the case, if it remains at that level, if and when India grows at 8%, it will create inflationary pressures. So if you grow at potential, it's good. But if you grow well above potential, it may sound like you're doing well, but it's actually not very good from the macro point of view, because you're putting pressure on macro, on inflation. Therefore, the question for us is, as we hope to see a faster growth, what are we doing now to increase the potential growth so that when growth is higher, it doesn't put macro pressures? And theory gives us some answers, but reality can be quite challenging and different. Theoretically, India, to improve potential growth, to increase potential growth in India, as in anywhere, investments need to be higher, private investment especially. Public investment is doing great. Question is, when will private investment follow? And we heard from the chief economist, that chief economic advisor, that the private sector actually has positive savings. So they're sitting on money somewhere. So can they invest so that future growth can be higher without putting pressure on the macro? Productivity also needs to be higher to increase potential growth. So technology is doing great. Can other things be put in place so productivity can be higher? And existing investment needs to be used. Instead of investing more, maybe existing investment needs to be used to increase the capacity of the economy to grow. In other words, unlocking the potential of existing assets, such as land, such as human capital, especially on female labor force side. These are capabilities that exist already. There is land, there is trained workers, including among women, those assets are not being utilized, perhaps because there are some constraints. So if those constraints were to be removed, it will increase potential growth. So maybe I just add one point before moving to the next paper. On the global forecasts, I'm wondering whether we can talk a bit more about Japan, because recently, after many years, Japan has signaled that they can increase interest rate. They've increased it once, and maybe they'll continue increasing it. On the graph, I couldn't tell whether this has been factored in, but Japan is close enough to India that if its economy were to really peak strength, maybe it would be good for India. So I would be interested to see whether the IMF has looked at the specific case of Japan going forward from the long-term perspective. On the second paper, it's fascinating, on Nicolas' paper, really very interesting. If I were to give a title slightly different, and I love the title is great, but if I were to be pressed to give another title, I would say it's The Rise of the Rest. Or is it China plus one? So these are the two things, the two ways I approached the paper. And why the rise of the rest? I think the paper gives us the impression that the world is becoming more globalized, more integrated. I don't think it's the case. I think it's just that the rest, which is non-OECD countries, non-Western countries, are becoming bigger. G20, non-developed G20 countries are becoming bigger. The rest of the world economy is becoming bigger. So as they become bigger, we see that they're becoming more impactful. They influence themselves and they influence the rest of the world. But I don't think it's because they're more integrated than before. It's just because the links that were there, the connections that were there are more potent, simply because the flows are bigger, whether it is through trade, through global value chains, through financial flows. And so the question is, are we resting on our laurels about globalization? I think we should remember that in the recent past, trade barriers have increased. Global trade, as Poonam showed, is barely increasing at the rate of global economy. So we're not seeing more integration as such. Can we do more as a global community for globalization to be better? And we've seen, including from advanced economies and industrial policies, in OECD countries have not been very friendly to integration and global trade. So the paper is really about the rise of the rest, in that sense. And the second way I approach the paper is the China plus one lens. And here, I wish we had more data specifically on India in the paper. We see a lot of data on China. You disaggregate China, but every now and again we see India popping up on some slide. But it will have been nice to look at G20 emerging market economies without India and with India, or showing India specifically and how it's impacting other G20 countries and the rest of the world. And I know you didn't prepare the chapter specifically for India, but since we're in India, we'd have liked to see more India-specific data. And why I say this may be China plus one is because I'm not sure when so the data shows that, say, China economy is not doing well, it impacts negatively other countries. I'm not sure it's the case for India, and I would like to know whether there is co-movement between China and India, or whether there is decoupling. And it is possible that India is doing very well today because China is not doing so well. And if we hope that China will pick up and grow at 6, 7%, 8%, is it good for India's 8% growth? If I want 8% in India, should I pray for China growing at 8%, or should I pray for China remaining at 4%? And I don't have the answer. I would like to know. So, and the data, you have a lot of data in the paper, but it doesn't give me that answer. And it would be interesting. We know that when OECD countries face a shock, it impacts everyone, but we know it impacts India less than most other countries. We did some work in the bank a year ago showing that India is very resilient from those shocks. And it will be nice to see what happened when there is a shock in China, whether it means positive growth for India, and it could be the case, or whether it means negative growth. I'll very quickly, I know I've run out of time, but I would also like to say that as the rise of the rest become reality, I wonder whether this is being facilitated by by energy transition and transition to the non-oil economy, as we saw in Poonam's presentation. I know China is doing very well partly because China is investing a lot in renewable and the world is buying a lot from China. So is it good? And I think it's good, but is it a factor in the rise of the rest? And it could be, and if it's a factor, for us at the World Bank, it would be good to know, because then we can work with developing countries for them to encourage them to really invest in renewable, in a more forceful way, because it is perhaps a path to having a bigger share of the global economy. And the second sector I wanted to highlight here is IT and technology. Is it also part of it? It probably is, from India's perspective. I think India's part of the rise of the rest is driven by IT export. And I would like to know whether it is born out of your data. And it will also help increase productivity for the rest, for emerging market economies, if they embrace digital development and technology faster. So these two sectors caught my attention, but otherwise, really, I learned a lot. Great presentation, and I'm looking forward to the discussions. Thanks.
Thank you, everybody, and congratulations, Mehdi, for impeccable timekeeping. I have a couple of questions which were originally intended for the Chief Economic Advisor, who sadly left us, but I think in his stead, anybody on the panel is welcome to reply. So we've heard a lot about the resilience of the Indian economy and the positive outlook for growth. We are in the middle of an election campaign, as I'm sure everybody knows, and if you look at the pre-polling data, by far the most important issues that voters highlighted that they were concerned about in the run-up to this, employment and the rising cost of living, sort of completely even across all the surveys. And there is a problem that everybody knows about in the economy, in the Indian economy, related to jobs, which haven't kept up with the economic growth and the overall macro environment. So I just wondered what could be done to improve that, to make sure that this, in the next sort of 10, 20 years, as India strives to become a developed economy, what are the policies that need to happen in order for that growth to, A, create more jobs, and B, become more broad-based, because it's also been, as I'm sure everybody knows, too, very unequal growth. There's been rising inequality in line with the rising growth rate. And the other thing is most of the world's historically fastest growing economy, if we look again at the next sort of 10, 20 years for India, have been very open economies. And in India, actually, the reverse has happened, right? You've seen a drop in FDI. The share of exports as a share of GDP has fallen. And India has declined to join ASEP, the Asian trade agreement that most other relevant countries in the region are part of. And I just wondered what people thought in terms of those policies. Are they okay? Is India going to be able to grow faster than it currently does without more trade and more openness, or is there a change needed? Maybe Poonam? I'm sorry to put you on the spot.
Sure. These are personal views, not stepping in for the CA at all. So let me actually respond to three things. One was that Auguste mentioned potential growth rate. What is India's potential growth rate? What is the right way to think about it, to measure it? And what is the right way to think about where it's heading? Second one on employment, and third one on external integration, both through trade and through FDI. On potential growth rate, I have been in a more technical space prior to my current admin role that I do partly here at NCER. And no matter how I tried to look at potential growth rate in a technical sense, it was never satisfactory, right? So those in the audience who do it, you take a residual or you do a structural model. So whether it's 6%, 6.5%, whether it's a dynamic growth rate that's changing over time, it's just that our models are not able to keep up with it. Those are very, very open questions. Growth is a dynamic process. If you think about it, the quality of investment in India has improved. When you just plug in an investment number and you try to get your potential growth rate, it may not give a very accurate number. If your quality of investment has improved, if your infrastructure has improved and you're not accounting for it, if the productivity of investment has increased. In one of our flagship events at Neem Rana in December, there were some folks from the private sector who said we need much less capital than in the past to produce. So it's a different argument than the quality of investment. It's about the efficiency of investment or productivity of investment. Is India labor force becoming increasingly skilled? It still has a lot of ground to cover, but has it become increasingly skilled? What about digitalization? So once you plug in all this, along with the fact that India is still a low middle income country, many states are still low income states, which means that you bring it all together and you may question the calculations of potential growth rate, it being a dynamic process, and because the right-hand side variables are changing, not just in quantum, but in quality as well. So what is the answer? I don't know. It's just that when I don't know something, I don't use the data. So at NCER, we don't project a growth number to a decimal point, right? We looked at the data and we said, well, maybe more than 7%, why not? Because we are not seeing any risk. Similarly, for potential growth rate, my sense is perhaps it's higher, and if not, it can be increased further, right? Because that's how a number of factors are looking. On employment, actually, Lena, employment is a variable that's very, very challenging to interpret, right? And the baseline numbers show very low unemployment rate. The moment you disaggregate, you see a lot of employment is in rural areas, and it's self-employment. And we understand that it's not necessarily very high quality in the sense that they are not earning, the people who are engaged in those activities, very high levels of income or growth rates. So what should be done about it besides the quality of employment data? We talked about agriculture a little bit. So India's agriculture accounts for about 16-17% of GDP, but 45% of employment. Agriculture is a very unproductive sector. So any discussion about employment, quality of life has to start with agriculture, in my view. How do you make it more productive? It's less than half as productive as the rest of the economy, and one can do those quick calculations. Going forward, should our policy framework shift towards more efficiency in agriculture, more urbanization, more internal migration from the places where there is excess of labor to places which need more labor and which can employ them more productively and human capital. So I think we will have to shift our focus to a little bit of a sectoral lens, rural, urban, state level focus if we really want to address the employment challenge that we have. On exports and FDI, there are a number of ways an economy can integrate internationally. One is through trade, more exports and imports. One is through portfolio investments, which are fickle, which go up and down without necessarily having to do anything with the domestic fundamentals, and FDI. My view always has been that FDI on a net is beneficial for the economy. We are talking about the economy needing more investment. Where would that investment come about? We are talking about India's current account deficit being very low, 1 to 1.5%. Can we afford to expand that a little bit by financing it through FDI? And I think it's a very important policy issue which needs to be looked into. Exports is something that others have talked about, and so I won't venture into it. My one-liner of FDI is that it brings finances, technology, and access to market. And on a net, if you look at the experience of other fast-growing emerging markets, especially in East Asia, FDI has been a very important part of their growth journey. And I think we need that in India too. Thanks.
Cool. Thank you. Okay, over to you. Is there a microphone to go around? Yeah, lady in the middle over there. If you could introduce yourselves and ideally say who you're asking the question, that would be great.
Okay, I'm Moushumi from Delhi School of Economics and also a visitor at NCAER. So my question is to Mehdi, and in fact, my question is very similar to Lena, but not India specific. I had written it down before she asked it. Is that it's a macro outlook, and I'm a bit surprised that unemployment doesn't feature in there. And unemployment is not a concern only for India, and especially because on the risk side, on the positive side, when you analyze the risk and the positive, you talked about productivity driven by AI, and the counterpart is unemployment. Then if you have to look at the world outlook and consider unemployment as a risk, what would be your take on that? Thank you.
Should we collect a few questions?
Yeah, okay, let's do that. Gentleman in the front.
Yeah, Manas from IMT Gasipur again. I just had this question because we talk a lot about the digital economy. And we know that there are issues out there. There are issues that people might not be able to handle the digital economy, especially people far into the rural areas. They might not have the skill sets out there. So if we are trying to move into into a system where we use more of technology, what should be the policies that should be there to take the population along with us? If we do not do that, then we will be creating holes out there. Some part of the population will go ahead, and there would be others where they would be left behind. And that's not a kind of a thing that we'll want to have for any country whatsoever. Thank you.
Okay. Yeah, over there.
Hi, thank you. Arjun Ramani, Lena's colleague at The Economist. I have a question about services-led growth and growth sustainability. So we all know that India's growth path is much more dependent on services exports than manufacturing. And the question is, can that generate the same type of spillovers internally as manufacturing does? Can you construct a new growth model? For example, can people learn and rescale in the same way that they do in manufacturing? And it seems like services are starting to adopt many of the qualities manufacturing used to have, such as they're more tradable and they're more exposed to technology. So I'd just be curious to hear the panel's reflections on that.
Cool. Okay, one more maybe. Anybody else? Yeah.
I'm not an economist. I am Group Captain Rajendra Joshi, but I hold few finance and other this thing. My question is about sustainability and climate risk. Have you factored those in your scenario analysis? Because the situation will be totally, have you factored the transition risk which will arise, because we have goal, every country has the net zero goal, and how it's going to affect the projections? Just a simple question. And how the risk and opportunities may be for some countries which are working toward the renewable energy.
Cool. Okay, thank you. So we have employment internationally, access to the digital economy, services versus manufacturing growth, and climate risk. Who would like to take which one?
Thank you very much, and thank you very much for the question on unemployment. It is part of the chapter 1 of the World Economic Outlook. Because my presentation was on the short side, I didn't dwell too much into it. Labor markets have been very strong. Unemployment has been very low in certain countries, and that's true, particularly in the US, where we've seen very low unemployment numbers and growing labor force participation. We had this one graph showing that this has been boosted in particular by immigration. And so that has been a factor behind the supply side boost to the US economy, but also to other advanced economies like Canada and to some extent the UK and the Euro area. Now, unemployment is an issue in many economies, and we've also highlighted that in chapter 1. So I invite you to look into it also further, and happy to continue the conversation. And I think maybe one aspect that I wanted to also come back to was on the global environment, and there were a couple of questions that were raised on the trade outlook for the global economy. We've highlighted the risks of geoeconomic fragmentation materializing with trading blocks forming around key economies that would stop trading between blocks. And we actually have a box in chapter 1 of the World Economic Outlook for this April that documents that these scenarios seem to start to be unfolding in the high-frequency data that we've been looking at. Although the global trade seems to be plateauing as a share of global activity, we've seen some reallocation with trade across blocks starting to slow, while trade within blocks starting to increase. And so the trade global outlook is one where there are further risks of geoeconomic fragmentation, and that could have implications also for all economies and for India also. We've done work, scenario analysis to see what could happen. So that hasn't materialized yet, but what are the risks on growth from fragmentation? And we found pretty large potential risks on the global economy, amounting to a total of 8% of global GDP if fragmentation was to materialize. We find that in particular commodities and commodity markets would be impacted with a rise in commodity prices and a rise in the volatility of commodity prices ensuring coming from further fragmentation, and with implications actually for also the green transition. We've published a World Economic Outlook analytical chapter precisely on that topic in October, where our policy advice was to really try and continue global coordination on climate and on trade policies for commodities, in particular for those commodities that would be so essential for electrification and for reducing carbon emissions, and those commodities would be metals, what we call the green metals in particular. I think I'll stop here for now. Thank you.
Thank you.
If you want me to, I thought I will ask questions rather than answering, but I'm happy to comment. On unemployment globally, I agree with the question. I think I was also wondering, if we want to really focus on people, we should look beyond, the growth numbers and see what it really means for people. And it's good in the US, we have data on unemployment. It looks like the labor market is good, unemployment is low, and it's probably it helps the US. The US economy is doing very well, and maybe it's growing almost at potential. But in many other markets, we don't even have enough data on unemployment or employment. So I think as a global community, for the World Bank, the IMF, we should work a bit more and get data on unemployment and what growth means. I mentioned the low-income developing countries earlier. One of the reasons why it's a social concern is because I didn't elaborate, but it's the unemployment channel. If those countries are not doing well and they have young population, they need to create jobs. What would they do? I mean, in many low-income countries, in Africa in particular, the young people are really expecting to have jobs, and they get educated and they want to have jobs. So we should look at these unemployment numbers, when we look at the global economy, so it can give us a sense of where we should put our emphasis. Then on digital economy and the digital divide, I agree that again, there was an article in The Economist actually a week ago or so where they were saying, India's growth has been driven mostly by the IT industry and large firms that do well, but they don't, necessarily reach some segment of the population, and especially in the rural areas, and so it is a concern. I think the policy response is to put in place a mechanism to have the rural economy also embrace the digital era. As India is doing already, the DPI, the Aadhaar system, it's really far-reaching, it reaches out. Maybe the next step is to see on two things. First, on the access to physical infrastructure for digital. Because our data show that a lot of people in the rural areas have access to physical technology for telecommunication, but not so much for the active use of the internet, because bandwidth are limited, perhaps, or because they don't have resources to own a digital equipment. And the second thing maybe is on the education side. A lot of we assume that you need to have a strong command of English in order to use digital, but maybe it's the case, but maybe we need to change that. Maybe we need to make sure that people don't need to speak English to be very savvy in using technology. Again, India offers some good examples. I've seen a lot of content which I don't understand, meaning it's not in English, it's in a local language, and it's very encouraging, but maybe more needs to be done. So anyway, investing more in digital assets in rural areas and helping ensure that language is not a barrier. Perhaps some ideas to reduce the digital divide, and service and spillovers. I don't have a good answer, but my assumption will not be that services will have less spillovers than manufacturing. I think underlining the question it sounded like this was your assumption. That will not be my starting point. Having said that, I don't know what the actual answer is, but my intuition as an economist, when I think of input-output matrices to look at, spillovers and interconnection between various segments of the economy, services actually connect a lot to others. Services are exactly what the name says. They are sectors to service the rest of the economy. That's why they're called services. So they're servicing the rest of the economy. They're not verticals. They're not just producing, it's like you produce steel for steel. So services are there to support your steel industry, to support any manufacturing, and to support services, actually, also to support investment as well as to support consumption. So services, by definition, have spillovers. I don't know whether they create as much job as manufacturing. That's where we can have debate day after day. But in terms of spillovers to other sectors, I don't think there is a concern. I think they're created exactly for that. And climate risk, yes, I agree with your concern. I think fully agree. We need to incorporate that. And as countries move toward net zero, which we all want, we all need, yes, there are transition costs. There are physical costs of the climate change hitting us, as we've seen recently with heat waves and floods. But yes, there are also transition costs. How will the economy adjust to the new net zero? There will be winners and losers. And I don't know, I can't speak for the IMF. I don't know how this has been factored into the forecast, but it should be because we can't assume that economies will learn to net zero by 2050 or by 2070 without any transition costs, especially for developing countries. We were talking about employment earlier. Many people may lose their jobs, and how are we reskilling? Are we reskilling ourselves so that we can embrace the green economy, the renewable economy, so that when we leave the oil industry, we can still work in new sectors. So I agree with your premise. Thanks.
Yeah. Just to add to this, and thank you for raising that issue. We've done a lot of work on transition risks and on climate in general at at the IMF, we published a World Economic Outlook chapter in October 2022, I believe, that was precisely looking at what are the macroeconomic costs in the short term for the green transition. So we were looking at short term for us in that report was looking at what macroeconomic costs in terms of GDP and inflation we would need to see to get to the path of net zero by and reductions in emissions in 2030 that would be consistent with the net zero path that other institutions have put forward. What we found is that by imposing a carbon tax early, those costs would be minimal and totally dwarfed by the risks, the costs that climate risks would impose on the economy on the physical side. We also found that delaying implementing a carbon tax or climate policies would increase those costs, those macroeconomic costs on GDP and inflation quite substantially. And so the policy advice was to really push for a gradual increase in carbon prices that would lead to reallocation of investments to cleaner energy sources. We've also published other papers on how to do differentiated carbon prices across economies, with some economies being able to go faster because they rely less on dirty energies and have more capacity to move with a higher price of carbon faster, and others starting with a lower price. And that's also papers that I'm happy to share that we put out a couple of years ago. Thank you.
Cool. Thank you. There's one more question in the first row. Possibly time for one more. Yeah, over there at the back.
Thank you. I'm Pradeep Mehta. Let me pick up from the last discussion that you had. What has not been touched upon, which is a humongous issue, financing, climate financing. They're looking at a need for $9 trillion, $7 trillion, even the estimates continue to vary, by 2030. And where is this money going to come from? It's going to come, it cannot come from the bank or the fund. So that is something which the world is still grappling with. And I find to my dismay that there are no solutions. Even at the COP28, the loss and damage fund, which is a very creative fund which has been made the first time, the US contributed $37 million, which is not even peanuts. And they're totally against it. So you're looking at a humongous problem in order to deal with. What we've added to climate is also biodiversity, if you look at the kind of losses which are happening. So if the world has to move forward to salvage the harm, particularly in the developing world, is going to be something which requires a little more understanding than just publishing good papers or graphs, with due respect. If one has to deal with these political issues, like catching a bull by its horns. Secondly, Poonam, the issue that you raised, I think one of the issues in the issue of deficit which we talk about constantly is something which we did not speak about. The deficit in the states, it's about another 5 to 6% you could add to the central deficit, which again is a problematic issue. And thirdly, what is also happening is a lot of our investment is flowing out. Now, a lot of it doesn't get reflected in data for the simple reason it goes through Hawala. For the simple reason that there are issues, there are problems in terms of finding investment opportunities here due to ease of doing business, which again requires a lot of work to be done. And finally, moderator, there is one has to look at India as a big market, which itself is a big magnet for growth, rather than to depend upon external forces for growth. Thank you.
Okay. If your question is very quick.
Very quick questions.
Very quick one. Yeah. Just microphone over there. Yeah.
Hello, I'm Shubhashri. I work at the NCAER's Macroeconomic Center. I had a question regarding inequality in growth, especially in the context of least developed countries. how much is rising inequality in the least developed countries taking away from potential growth in the LECs, and how much is that expected to, how much is that taking away from the current growth projections which the IMF has for the region?
Thank you. Very last one. Okay, very, very quick, very last question.
Yeah, this question is very quick. I'm Alok Jaina from NC, National Center for Financial Education. This is regarding this Fed's last decisions regarding higher for longer, where the interest rates, the probability of cuts has been list. I think they're talking about deferring the interest rates cuts. And does it really impact the interest rates and the growth in US and also the growth in India? That's one. And number two is that there is a decoupling between the growth in US and the interest rates in last 1 year, whether this is going to continue there in US, and the same thing in India also. I think this question is to Mr. Mehdi.
All right, thank you. Okay, who would like to answer?
So I was wondering, Lena, Nicolas never got an opportunity to respond to what they said here. If you want to take that.
Well, I mean, I would actually comment on the question regarding services-led growth and relatedly the questions on structural reforms to support this digital economy. And there have been recent IMF research that looks at kind of how structural reforms can boost growth, and specifically emphasizes in their empirical findings the importance of sort of setting the stage for later structural reforms with kind of first-generation structural reforms like those to governance, and then other reforms to the business climate and so on. So I think the message is essentially that it's not really possible to sort of predict the future and understand what the future of growth will hold, but what you can say is look at the data and understand what are the policies that allow an economy to take advantage of opportunities and create jobs with those opportunities. And so that would be I think our message for those questions. Thank you.
Okay, thank you. Anyone on? I think the climate finance one is maybe one for the tea break. And any thoughts on inequality in least developed countries?
I was actually gonna. I wanted also to respond to the climate finance because the IMF has introduced a new instrument, the Resilience and Sustainability Trust, that already more than 10 countries have been applying and working with, and that's on top of what we do on the analytical work. Now you're right that the financing needs will be extremely important for, very large for the transition to materialize. And part of the reason why we've been pushing for a price of carbon and carbon taxes is that precisely because that would be a source of financing that would allow raising revenues on top of putting a price on an externality that would deter investment in carbon-intensive solutions that will also create fiscal space to tackle part of the costs associated with the transition.
Let's take it outside. Lena, is it okay if I take 30 seconds to respond to some of the things?
Yeah.
Please.
On climate finance, we may not be satisfied with my answer, but I think climate finance we should see these 7 to 9 billion. We have them already. We have them. We're just misusing them. We're just spending them on something that we shouldn't spend them on, and then we're waiting for a manna from heaven, somebody to come from another planet and give us 7 to 9 trillion and say, hey, you have another 7 to 9 trillion to spend on climate. No, it won't happen. Nobody will give 7 to 9 trillion to anybody on this earth for climate finance. Let's be real. So climate finance is what we're spending. This electricity we're spending money on, we're spending time on something. This time, are we thinking how we embed climate into that? What is the carbon footprint of this meeting? So this is climate finance. To me, every government should look at their budget and look at it as climate finance. Private sector should look at the expenditure is climate finance. Household expenditure is climate finance. Our development financing, it is climate finance. If you add all this together, it's more than 9 trillion. So we have the money, let's just use it for climate. Climate is not devoid from development. It's not devoid from growth. We can't spend money on development and growth and then say, okay, now we need to find money for climate. It's the two sides of the same coin. So we have the money, let's just call it climate finance and let's use it for climate finance so that growth and climate are embedded and we grow and create a better world and we live on a livable planet. To me, that's my answer. But I know it sounds a bit naive, but that's what I say consistently. And unless we push for this narrative, it's not going to work. So that's my suggestion. On inequality, I think there is no dichotomy between inequality and growth. I don't think focusing on inequality detracts from focus on growth. The two go together. There are a lot of papers which have been written showing that high level of inequality is actually not good for growth. Now, I know you need to have some inequality for growth because we cannot all be equal on the planet and have incentive. You need to give incentive to people to compete, and that creates some level of inequality, but that's not the kind of inequality we're talking about. When we talk about inequality, we're talking about inequality that has reached a level where it is bad for growth. So I think we should purposefully address inequality while seeking to grow. Thanks.
Thank you. Okay, Poonam, final summary.
I'll just take a few seconds. On services-led growth, co-panelists have answered it very, very well. But I will also point you out to some of the work we had done many years ago. That's when services sector had started to pick up. We had actually looked at the input-output metrics, employment intensity of services growth, quality of employment in services growth, and we found very optimistic numbers. Increasingly, this distinction between services and manufacturing is a false one. Each process is very similar, and it's somewhat arbitrarily that we call something manufacturing and something services. If it's food processing, it's called manufacturing. Food bought in a restaurant is called services, right? So I think if we are serious about this, we need to look at the definition, but overall, it's very high quality growth, and it's increasingly tradable, which means the constraint that we used to have earlier that you cannot supply to the global market is not true anymore. On climate finance, while I'll agree more or less, having worked at both the IMF and the World Bank in the past, at times World Bank and IMF colleagues speak the language of their largest shareholders. So when it comes to carbon tax, etc., let's take a step back and think about how it works for each country's circumstances. And are we really giving a safe passage to the countries who had promised climate finance and now they are not able to meet? So let's just join another bandwagon that now you tax carbon and we'll see. I don't buy that, right? It's not objective in my mind, and it's state finances. This is something, the new direction in which we are moving at NCER is to look at state-level public finances as well as growth processes. I try to give a little bit of flavor to that. I won't be able to do justice to this question, but we had presented a paper at a flagship conference last July, India Policy Forum. The title of the paper was India's Debt Dilemma, in which we also talked about public finances at the state level. Just 2 bullet points. There is a great deal of heterogeneity when it comes to public finances of the states. Some of the states are on a virtuous path, and a handful of the states are on, are going to have more or less a blow up in their debt to GDP ratio. Consolidated public deficit to GDP of the states is about 3.5%. Cumulative is 7, more or less, 3, 4, 4.5 adds up to 7.5. 4.5 is the center, 3 is the state cumulative, and that's how the numbers work. I'll stop here. Thank you.
Cool. Thank you so much. Thank you very much to the panelists for the interesting discussion. Thank you so much for coming. I believe there's some tea and coffee outside and possibly some food. Thank you.
I had to thank everyone. Thanks, Lena. Thank co-panelists, our stellar NCER team for making this happen. There's high tea outside. Please do join us for that.